This past weekend, OPEC agreed to raise oil production into a falling market, pushing that market one step closer to the edge of confirming a major global downturn. This is why, despite the fact that production rise wasn't nearly as much as people were thinking, the reaction across the energy space was relatively muted. That's because the oil sector has a lot more to worry about, including a recent bout of Eurodollar tightening that goes right along with everything that's reshaping the oil curve and suggesting something we haven't seen since 2008, 2015, or 2020. Now, oil prices have clung to the lower $60 range due to nothing more than geopolitical fears that some major disruption will break out over some conflict in some existing hotspot. Now, those fears are being drowned out, at least by OPEC bringing back additional supply, thereby lowering the chances that flying missiles will cause significant damage to the international flow of oil. But all that's just the near-term stuff. Markets are seeing epic imbalances looking into next year and beyond, with one major commodity firm calling it, quote, cartoonish. While everyone focuses on these supply issues, the main problem is always demand, which is something that you can clearly see on this one chart that Bloomberg put out this morning in the wake of the OPEC decision. Every time the oil market flips into a, quote, supply glut, the global economy is in complete downturn. It doesn't get to be any clearer examples than this: 2008, 2015, and 2020. Three of the world's biggest downturns of the past century and their worst and lackluster aftermath. And not coincidentally, those are the same periods when long-term interest rates hit lower and lower and lower lows. And if everything keeps going this way, the oil futures market will indeed flip into contango and confirm the fourth major global downturn. And the fact that we're also seeing these Eurodollar tightening signals not only corroborates that signal, it also contributes to the conditions which are feeding into it. We've got repo fails that are rising, U.S. Treasuries disappearing from foreign official hands, and even a sudden increase in interest in the Fed's securities lending program. But first, though, we'll get to OPEC. What CNBC reported today is that oil prices rose more than 1% on Monday after OPEC Plus planned production increase for November was more modest than expected, tempering some concerns about supply additions, though, I love how they throw this in there at the end, a soft outlook for demand is likely to cap near-term gains, and it's doing a whole lot more than just that. Brent crude futures climbed 96 cents or 1.49%, to $65.49 a barrel by earlier this morning, while U.S. WTI crude was at $61.74, up 86 cents or about 1.41%. The market was expecting a somewhat larger increase from OPEC Plus, as shown in the structure last week, according to an analyst at Rystad. However, the modest 137,000 barrels per day bloats the already oversupplied balance for the fourth quarter of 2025 and 2026. Now, what they're talking about was that there had been persistent rumors the cartel might dramatically accelerate its production restoration plans, with some reports going as far as to say maybe 500,000 barrels per day. Now, that was always just some whispers. In reality, it didn't matter much in the end. Yes, crude oil is rising in price today, but it's hardly the kind of major buying signal beyond some short-run sigh of relief, especially after the large declines last week. More important than that lack of major buying Monday morning and even into the afternoon here, the curve spread keeps flattening. The front-end spread for WTI futures, the U.S. crude benchmark, is down to just 35 cents despite the temporary rebounded price. The 3-month benchmark is barely 70 cents, the same as it was last week. I almost never do ads, and I say no to the vast majority of those that are brought to my attention, but I was thrilled to be able to work with today's video sponsor, Monetary Metals. And the reason is because they're solving a big problem, one that I've been highlighting for a very long period of time. Gold is a safe haven, but other than sitting in a vault, it doesn't do anything. Monetary Metals fixes that. They let you earn real yield paid in physical gold without giving up ownership. It's not a fund, it's not a paper claim, it's your gold working for you. Every month, more gold gets deposited into your account. It's simple, it's transparent, and it is fully insured. If you believe in gold as a long-term store of value as I do, this changes everything. Go to monetary-metals.com/Snyder. That's monetary-metals.com/Snyder for all the details. We absolutely thank them for being the sponsor of today's video. And now let's get back to it. The global market has been fixated on a glut for months now, one that has been driven by an economy that is faltering all across the major systems. However, recent data is beginning to show this glut, this supply glut in oil, is no longer some future concern. This thing is starting to happen right now. It's beginning to take shape here in the present. Bloomberg reported this last Thursday. Unsold Middle Eastern crude cargoes from the recently wrapped up trading cycle are pointing to early signs that an expected global oil surplus could be starting to emerge. The volume of unsold oil set to be loaded in November ranged from 6 million barrels to 12 million barrels, at least according to estimates from traders who are familiar with the matter, asking not to be identified as they're not authorized to speak to the media. Sellers include the UAE and Qatar, and as the monthly spot trading cycle ends, shipments are usually discounted to move them, and price-sensitive buyers in China and India are the typical purchaser. However, there's no indication that these unsold cargoes have yet been snapped up, at least according to the traders. So those in the market have been talking about this supply glut from the perspective of supply for quite some time. And while OPEC didn't add back more production than maybe some people had feared, it doesn't seem to matter because it's really about the demand side. And it's not the demand sides for, some distant point in the future. We're beginning to see it actually emerge. What I mean is there's more supply than there is demand because there isn't nearly enough demand. And there are many signs that demand is falling off. At the same time, Eurodollar system and Eurodollar funding is tightening. And all of that is conspiring to push the oil futures market further and further toward contango, which would be a critical signal. And I'll tell you exactly why that is as we go through this video. But you have to understand, our modern world is price inelastic where it comes to energy. We need it for everything, and we only need more of it. And despite efforts to go in other directions, fossil fuels remain at the core of the entire economy. Now, what I mean by price inelasticity or just insensitivity is that because we need oil, we pay whatever price is being charged. The amount of crude the world uses is related to the amount of economic activity taking place, regardless of price. In other words, unlike most commodities, or even, as we saw during the supply shock, higher oil prices themselves don't lead to a loss in demand for oil. The global system pays the higher price for it whenever it does get to be high because it's that essential. Volume stays so long as the economy is moving forward. But when volume of oil and volume of demand for oil falls off, that's because the economy does, meaning a supply glut in crude is a warning sign about the state of the global economy. Volume slides, prices crack, and oil producers have to shift focus from production to storage. That's the other variable in this oil economy equation, for lack of a better term. It's storage. Production of oil is relatively inelastic in the sense that it isn't easy, or in many places even possible, just to turn it off, especially when prices sag and demand falls. Now, OPEC has some ability at the margins, as we saw the last couple of years, but the group instead does the opposite of what it should according to basic economics. They pull supply off the market when prices are high, but then they add back that supply when prices are falling, because by then the cartel's members are desperately hoping for a pickup in production volume that will, for them anyway, make up for these lower prices. It's the energy market equivalent of buying high and selling low in the stock market. And we're seeing it all over again with panicky OPEC states trying to volume their way out of low prices and only making everything worse. Again, because oil supply everywhere takes a very long time to respond to changes in demand. So the only way the market can reconcile what the mainstream calls a supply glut, which is really under demand, is through lower prices. But also importantly, it turns into a price structure on the futures curve that encourages oil to go into storage. And the more incentive there is in the market to push oil in storage, the more activity in the real economy must be falling off in order to push the market to do this. Again, demand for oil is inelastic to price, which means if demand is falling off for oil, it's because there is less demand in the economy for all the rest of the economic activity. That's what we're really talking about here. And oil is a critical real-world signal about the state of all of these things. As Bloomberg reported today, the oil market is heading for an immense surplus in early 2026. How large? Cartoonish, reckons Macquarie Group, a bank with a huge commodities business. What's the solution? Stockpile millions of barrels of crude into tanks. It's a tried and tested response, but this time there's a catch. There's always a catch, but they're just catching on this time. Interest rates are much higher than at any time the oil industry has faced a similar situation over the past 25 years. Thus, financing next year's surplus will be expensive, and not for the reasons they think. The problem, which isn't getting enough attention on Wall Street, could amplify the wave of bearish sentiment hitting the oil market. The larger the surplus, the more expensive storage becomes. The cheapest option is large caverns and tanks, followed by smaller tanks near major refining hubs. But as those fill up, the industry slowly moves to secondary and tertiary locations, which typically are more expensive because logistics become increasingly complicated. And ultimately, traders may resort to the most expensive option, which is using tankers as floating storage facilities. Now, we can see this using any number of oil spreads where major contango has been clustered around three very clear episodes. As I said before, 2008, 2015, and 2020. The first and last of those are pretty obvious. The Great Worsen Recession in 2008, 2009, and then the pandemic and the lockdowns. Though this particular article that I'm referencing tries to claim that 2020's oil price crash was somehow driven by a price war between the Saudis and the Russians. It also says the 2015 oil crash was a price war between the Saudis and U.S. shale. That's because mainstream financial media is conditioned to believe everything, and I mean everything that happens, is because of some government policy somewhere. Furthermore, since no one declared recessions, what else could it have been? The pandemic lockdowns easily explained 2020, and any price war that took place during it was just in response to those economic conditions. The same holds true for 2015, or what we call here Eurodollar number 3. A massive swath of the global economy unexpectedly fell off sharply, leading a huge and permanent slowdown in places like China, combined with enormous contractions in emerging market economies such as Brazil. Brazil has yet to come back from that one of the worst contractions to hit the EM world on record. There was also nearly a recession in the US, not that many people noticed, thanks to, again, central bankers and the mainstream media. People knew something was up, that something was wrong in the economy, which is one big reason why the 2016 election turned out the way that it did. Either way, demand is the key here, but the mainstream media isn't allowed to tell you that story since it doesn't fit either with the top-down framework that we're supposed to believe in, or the narrative fed to us by central banks like the Fed that the economy is always in good to great shape. Never any worse than either of those. But this is exactly why Eurodollar University is holding our webinar on Tuesday, next Tuesday, October 14th at 6 p.m. Eastern Time, because we have to go through the hidden information that remains hidden thanks to all of these mainstream sources like the financial media and, of course, economics and central banks. There's a wealth of information, not just in things like WTI futures and the shape of the curve, but also just interest rates themselves. Interest rates themselves have been telling you and warning you and predicting that exactly what we're seeing unfold right now was going to be unfolding. But there's a lot more to it than just looking backwards. We need to look forward, and the only way we can do so is being able to look at this information from interest rates, which is what we're going to do next Tuesday, October 14th, 6 p.m. Eastern Time. There's a link in the description to sign up for the webinar. It will be well worth your time to attend. Now, going back to the article I just referenced, what it says is the contango can be measured in many ways, like I said, but one benchmark is the difference between oil for immediate delivery and the one-year forward price. And there are three factors typically which determine how wide that spread gets: the size of the glut, the cost of storage, and the cost of financing. Financing are really monetary conditions. That's the one that's often overlooked, especially when the narrative is oversupply rather than under demand combined with tighter money conditions. Financing is essential because no one puts up their own money to store oil. So unless you're a company with a lot of your own tanks, spare pipelines, or unused tankers, everyone always borrows to buy and store excess crude. So the more it costs to store, the steeper into contango the futures curve will go to make it economical to do so. Therefore, when we see the futures curve go into contango, that already tells us something very important about the size of the glut as well as the cost of storage. But it also tells us something very important about the borrowing conditions that go into those. The mainstream always cites interest rates, and they want us to mean central bank policy rates on the few occasions when financing and energy markets might even come up in these mainstream sources like we're seeing today. But it's not the Fed's Fed funds target that matters. It starts with treasuries and then gets into the more shadowy areas of the financing world. The cost to borrow funds that some speculator might be getting into to move crude into storage, it's not going to get quoted in the SOFR calculation made by FRBNY. So the steeper contango is also a nod toward tighter monetary conditions overall that you can't otherwise see unless you're paying attention to all these Eurodollar signals that we do here at Eurodollar University. Those are the other distinguishing factor during those three major periods that we keep referencing. Again, 2008 and 2020, those were definitely times very clear deflationary money, which everybody could see, which means money and collateral weren't flowing very well. So it was hard to acquire financing to store oil, which led further to steepening contango in the energy markets. And the same was also true in 2015, though once again, no one in the mainstream has ever acknowledged this. And we have mountains of evidence for Eurodollar number 3 tightness, from the dollar exchange value, which absolutely soared, even LIBOR back then and the TED spread at the time, to sharply lower swap spreads and all the usual deflationary signals that we go over here. Eurodollar tightening and recession conditions in the real economy go hand in hand, which is why you'll never see them in the mainstream and certainly not out of the mouths of central bankers. But we are getting more signs of dollar tightening recently. Now, I'll probably have to do a full video on these because I can't really do it justice in the remaining time that we have in this video, but we're talking about things like repo fails and U.S. Treasuries being used by foreign official institutions, even a sudden interest in using the Federal Reserve's securities lending program. I've covered all this stuff in a deeper dive, in our deep dive analysis at Eurodollar University. Even talked about this a little bit at Eurodollar University's One Big Weekly Theme over at Substack. But for now, we'll go over a couple of these signals. One of those is the dollar exchange value that's actually on the rise. I pointed out this before in a recent video that against key currencies that you can't see in DXY because DXY is dominated by the euro and doesn't include that many other exchange values in it otherwise, everything from New Zealand and Canadian dollars to Korea's won and Japan's yen, especially today, India's rupee, which is another critical Eurodollar canary, just as it had been in 2014 and 2015. All of those, they're on a months-long downtrend already, one that has picked up over the past couple of months of payroll mayhem, indicating job losses accumulating here in the United States. The weaker the U.S. economy is, especially from the labor market, the more risk-averse money providers are going to be, especially when they consider credit conditions, as we talked about in yesterday's video, the more it contributes to the cartoonish oil glut in the real world, and then pressures toward contango in the futures market. Another tightening signal comes from repo fails, which have spiked into the end of the third quarter, which is the latest data from the primary dealer survey from the Federal Reserve Bank of New York. And that one goes along with renewed use of the Fed's securities lending business, which I can't get into here. Like I said, I went over this in the deep dive analysis in more detail on what that actually means. But both of these together indicate disruptions in collateral flow. And one measure that I've talked about before here on YouTube, including recently, U.S. Treasuries that are being used out of New York. These are reserve assets that are largely owned by foreign official institutions, central banks and governments and reserve managers, etc. They're held in custody at the Federal Reserve's New York branch. And when dollar funding conditions in the world end up tightening to a substantial degree, such as 2015, those reserve assets do get used. Now, foreign officials either sell them or they lend them to local financials that are having Eurodollar difficulties. So when we see them start to disappear from the Fed's custody, that's because they're being used in some fashion, which means they're a dependable sign of Eurodollar tightening. And as you can see, going back to late April, the amount that has been used has been enormous, more than 160 billion, and here's the important part, the vast majority of that coming since the start of August. Yep, the July payroll report. It's a clear link to macro perceptions, which also ties back to a worsening U.S. labor market that is also feeding into the, quote, supply glut across the oil sector. That's because all of these things are related. They're basically looking at the same thing from very different angles. And in this case, coming closer and closer and closer to the same undesirable conclusion. So just like 2008, 2015, or 2020, the prospect of contango in oil is far more than OPEC's latest short-run decision. As I said, even that is really about OPEC members trying to deal with what's really going on here. Oil prices and the curve shape, they're all about real economics, the fundamentals of demand more than supply, plus financing conditions. So when demand is not enough to absorb supply, that means storage and contango, which draws in financing conditions even more to the future's curve shape. At the same time, demand downturn is driving financial conditions even tighter. That's why you see such a dramatic shift into contango at the start of these three periods. And the oil market has been warning us all this time about the shape of demand, which is why oil prices have defied OPEC's production cuts for going on 3 years now. Demand has never once held up. So should we see contango really develop on the oil curve, and really more than one oil curve, we'll see it in a whole bunch of them, it would be an unmistakable sign of a big-time global downturn in demand, plus deflationary monetary conditions that always come with it. Now, we aren't there yet, thankfully, but the fact that we're starting to get reports and evidence from the real physical world is not a good sign. And it's not a good sign that what we're seeing in the oil market and this potential development into contango fits with a world that's heading for a lot lower interest rates that are going to stay there a lot longer. It really is a consistent picture from all these various angles. Think 2008, 2015, and 2020. Yet contrary to popular perceptions, the dollar exchange value is rising again. Went over all of those signals in the video link below. As always, thank you very much for joining me. Join me next Tuesday, October 14th, 6 p.m. Eastern. Link in the description to sign up for a webinar. Huge thanks to Eurodollar University members and subscribers. And until next time, take care.